Okay, so the authors are looking to analyze the sources of returns in emerging markets and the factors that explain those returns. And they're using factors that are commonly found in a lot of the literature. The unique thing is that they've added the investability premium here. So we basically have a regression where we've got the excess return that is composed of the market return and its beta, the high minus low, which is the value versus growth, small minus big, which is the size premium, the momentum premium, which is past winners minus past losers, and then we have an investability premium, which is basically used or determined by a metric that is what percentage of the stocks in these countries are able to be invested in by foreigners, therefore making them more investable. And this is over the 88 to 2006 period. Now let's go down and look at the total first. We have a lot of different countries, but all countries together all end up being very statistically significant at the 1% level, and they've got pretty high coefficients here. So first, the market return is 1.28% per month, and so significantly positive. As the local market return, excess return increases, so does the return on average of the companies in these countries. The small minus big and high minus low has a negative relationship. So that would mean that large companies and growth companies outperform the small companies and value companies over this period and on average across these countries. And we see that most of these are statistically significant and most all of them are negative, so that's interesting to see. Also, from a momentum perspective, past winners tend to outperform past losers on average across these countries. And also the companies that are more, or the markets that are more investable tend to outperform the ones that are less investable. And since with the asterisk, all these are statistically significant, we could say that it's not very likely that these premiums are zero, and that in fact there is something to this. So next, the authors split the previous study into two different regimes. So in an up market and a down market. Let's go down to the bottom of the table so we can see the total averages. And what we see here is in an up market, all of the conclusions that we reach for the average conclusions are the same, where the market return or the returns of these companies on average are positively related to the market return, and also the small companies outperform large companies, growth companies outperform value companies, and past winners outperform past losers, and more investable companies tend to outperform less investable companies. But then here we see in a down state and in a down market, a few of these have changed signs. For example, the market return coefficient is now negative. So that would mean that in a down market, as the excess return increases, the return on average for all the countries decreases. The small minus big and the high minus low remain the same as far as sign goes. So we still have the large cap outperforming the small cap and the growth companies outperforming the value companies. Momentum remained the same, although the coefficient is a little bit less for the past winners to outperform the past losers. However, the investability premium has changed signs, so that would mean that now in a down state, less investable companies outperform more investable companies. So next, the authors want to understand the influence that each of these factors has on the excess return for the stocks in these emerging countries, so emerging markets. So they have 4 different models, and each one starts with the investability premium and then adds one of the factors until it gets to the complete model that we had before. So we have each of the models here is for all the stocks, and we have the market risk, the size premium, the value premium, momentum, and the investability premium. So starting with the first one, we have just the investability premium, and we see that it's very statistically significant. And when we add in the market risk premium, it is very significant as well, but the investability premium doesn't change in all these cases. But we do see that the market risk is the primary determinant of, or it most explains the return of the companies analyzed on average, because it's at about 0.6. The rest of these coefficients are a lot smaller, so they don't have as much influence as the market return does. But we do see that the investability premium is certainly significant in each of these cases, so it does explain a lot of the return of these companies on average. Next, the authors sorted here in panel B. They sorted the portfolios based on the more investable tier, middle tier, and least investable. We see here that in all cases the market risk premium is still the most significant explanatory variable in the regressions. But in all cases, interestingly, the size of these companies is very significant. The size premium is very significant as well. The value premium is kind of back and forth. Some of the regressions it's significant and others not, especially in the more investable tier. As the investability of the companies becomes more prominent, then it also becomes more of an explanatory variable of the returns, as well as the market risk premium, and these others become less significant, the size, value, and momentum premiums. So next, the authors looked at each individual company or country, and they find that the investable premium is significant in most cases. We can see that with the asterisks here. So we could say that the investability premium does hold some weight as a good explainer of the returns for emerging markets. So next, the authors looked at the same analysis that we just discussed, only they split it into 2 periods. So you have the 88 to 95 period and the 2000 to 2006 period. And we have pretty much the same results, where we find the market risk premium to be the largest coefficient here. So we could say the local market risk premium is the primary explainer of the returns in each market. And next, size is a significant explainer as well. Value and growth factor seems to be back and forth on whether it's significant or not, and momentum seems to be significant as well. But what's interesting is, as what we found before, and in both of these markets, as the tier of the more as the investability of the stocks goes up, the investability premium seems to go up as well. which would mean the returns of the companies in these countries become more and more sensitive to the investability premium as they become more investable.